family business DNA has always been that you build businesses over decades. My father, started working in his teens when he lost his father, and he's well into his 50s and he's still actively working. So it's taken him almost 4 decades to build what he's built. We've been investing for the last 8 years since 2016, have invested in over 50 companies across fintech, SaaS and consumer.
The fundamental ethos of a family office, the way I hear from you, is about truly understanding what it takes to build long-term business. Hi Shrishti, how are you doing?
I'm good, Sandeep. How are you?
Good. So great to have you with us today. But before we get going, you've been investing into the whole world of private market for a long time. Our audience is really keen to hear about it. And Private Compass is Oyster's guide to private markets. But before we get into this whole world of private market, why don't we get to know a little bit about yourself?
Yeah, sure. Thanks for having me here, Sandeep. I'm the managing partner at SSV, Swadharma Source Ventures, which is the family office of the Sahu Group. It's a diversified conglomerate across automotive, real estate, financial services, and hospitality. We've been investing for the last 8 years since 2016, have invested in over 50 companies across fintech, SaaS, and consumer, and continue to invest actively from pre-seed till pre-series A. And we've done 50 companies so far and continue to keep investing in the private side.
Oh, wow. So, private market is something not a whole lot of people know about it. From saying there's a mystique about it to there's an ambiguity about it to, not knowing anything about it.
Yeah.
How did you get into this whole side of private markets?
Sure, interestingly, my personal background has been on the tech side. I started my journey as a fintech founder, built a collections debt product in the fintech space, and that got acquired. So post that is when I moved on to the investing side. My interesting role at Meta was also leading startup initiatives for South Asia, where I got to work with startups adopting Facebook's developer and marketing tools. And that was where, I was fortunate enough to work with 700 plus startups across South Asia, and that helped build a founder network, which, obviously as a founder, you end up building deep networks in the space. And so that started out with angel investing previously, but, then now we've formalized it into a family office structure and have been investing directly now.
Awesome. So for those of you joining us today, Sandeep Sinha, co-founder and co-CEO for Oister Global. We are institutional investors and we invest in top tier funds across the venture capital, the private equity, the venture debt and the private credit side. So Shrishti, back to you. So, a lot of family offices who co-invest with us, right? We are seeing a very significant change that those who have been investing earlier in the listed market or probably just investing in their own businesses because their returns are so fabulous from there.
Yeah.
They are showing a lot more increasing interest in this whole asset class of private market. So, a little bit about how your family decided to invest into private market and the other family offices that you see. What's driving their interest in coming towards this side?
Yeah, actually I have a funny story to share there because, whenever wealth managers would come to my uncle and my father to talk about different asset classes that were available to invest in, they would always retaliate and say that, we generate 18 to 20% IRR in our core businesses. So why would we need to invest elsewhere? I think this was the conversation we would have 10, 12 years back. But ever since we started the family office and they've realized that, even in our core businesses, we've become customers of a lot of these tech companies. For example, Rupify is a company we invested in the pre-seed stage and we have been their customer for the last 5 years, right? And there are so many other companies also which we've adopted in different core businesses of ours. So it was a realization that, either you are going to get disrupted or you need to adapt to this change and embrace this tech wave which is happening in the country. And, we were seeing how it was impacting our own businesses as well. So that opened up our eyes in terms of private market investing. So we set it up in 2016, have been investing ever since, and more we are finding strategic plays for ourselves as well, where first we put in a small check, but then we become customers of the company and then we come in with a larger check at a later stage as well.
Oh, great. Fabulous to hear that. So the other thing that we are observing is that, in a lot of family offices, the next generation, the so-called the new gen of the family offices, their preferences, their approach, their way of thinking, how they go about picking a particular asset class is significantly different, right? So are you seeing that shift yourself? I'm sure you would be experiencing that at your own family office.
Yeah, absolutely. We interact with a lot of family offices, and it's mostly the second and third generation entrepreneurs who have the appetite and have grown with the DNA of business building, right? So they understand businesses are built over decades and not just months and years, where certain VC funds can have a more short-term approach to things, where the 10+2 model, but the family business DNA has always been that you build businesses over decades. So I think there's definitely that learning which they're able to take to private markets, where they're not taking a short-term approach, they want to take a longer-term approach and build businesses for decades to come. And so interestingly, what is happening is when these second and third generation folks get into the business, they may not find a place for themselves because the businesses have already reached a certain place. They might have professional management also running the companies. So in a sense, they also need to find a role for themselves within the companies. And interestingly, a lot of them have grown up being tech users themselves or have adopted different companies' tech products, which is where there is understanding that this is possibly the next wave of disruption that our businesses are also going to see. So the understanding and combined with the appetite of having risk capital to deploy, I think that is why we are seeing a lot more family offices embrace this theme, and plus the digitization aspect of it, how it's changing the businesses at a fundamental level. So I think it's a core philosophy of business, right? If there's no continuous improvement, then you die.
Right.
So it is survival of the fittest, in fact. So I think family offices are trying to adapt to keep up to the times, and that is why you see this new wave of capital being deployed in the private markets. But Sandeep, interestingly, you also work with so many different family offices. What is your take on why the family offices are interested in private market investing?
I think at the core it starts from the returns, and I
Yeah.
think more and more people are understanding that there's a genuine alpha when you invest in private market. In fact, we've just released a CRISIL report where there's almost at a 13.5% of annualized alpha that
Right.
comes in this space. And also we are making this whole process transparent. Family offices are getting a better visibility in terms of what are the different funds. We almost have kind of worked with almost 200 funds across the country. So what their metrics are, how they performed, what's the liquidity profile, and so on and on. But I think most importantly is the whole concept of diversification, which is where I think we are focusing on significantly. When you talk about private market, the first thing that comes to everybody's mind is, it's highly risky.
Yeah.
And that's true. There are the known knowns, there are the known unknowns, and we always talk about the unknown unknowns, right? Which is the huge issue.
Yeah.
But I think we have very with a lot of effort and diligence and deep insight, kind of figured out how to create the aspect of diversification. And I think it's that diversification which helps us on the risk mitigation side,
Right.
which is what is driving a lot of family offices to get interested into that.
Yeah.
But when you see at your end, right, the family offices, they've been investing into the whole the startup ecosystem for a long time. They have a large enough portfolio of their own.
Yeah.
Some of people investing like 1, 2, 3, 5 companies is, I think, manageable. But when it gets to like 25, 30 companies, it's almost like an unmanageable process.
Yeah.
How are you seeing that? And a lot of the die-outs that happen in this, there's a lot of capital that gets written off in the process. So how are, in your mind, family offices adjusting to the reality of the actual mortality, which rather than being a concept is turning into a reality?
Yeah.
How do you see that?
I think there is significant learning which has happened with family offices, because a lot of them burnt their hands directly investing into companies as well in spaces that they did not understand, because they were independent of the core business focuses that they might have had. So a lot of them are actually evolving their approach to find strategic investment opportunities where they understand the business really well and invest directly. And aside from doing that, they also have realized the need of finding the right funds to back, where the funds are actually managed by fund managers who do this professionally, who have deep domain expertise, and can support them in building their portfolios and help with diversification at large. Because when you're investing directly and you don't understand the industry, it can be very, very risky, especially you're not prepared for the illiquidity that comes with this asset class, even because in family offices the core theme is also liquidity, because you might need the liquidity for your own businesses at some point or the other, so you have to plan for that. And if you look at portfolios, you need to look at it at a portfolio construction level, where you can be exposed to different asset classes, be it public markets, be it fixed income. But I'm seeing increasingly family offices carve out more and more towards alternate asset classes also, whereas private market investments is picking up as a big theme within that. So there is a lot of that happening for sure.
So Shrishti, you talked about the whole thought around the whole liquidity aspect. So in a 10 plus 2 kind of 11, 12 year product, how is the thinking of family offices coming together to say this is an asset class they're willing to be committed for such a long period of time?
Yeah, I think the learning also is with success stories that have come out of the startup ecosystem, be it Zomato, Policy Bazaar, Info Edge. If you look at their investment, they made the most outsized returns at a 12-15 year time frame, where a lot of funds had the pressure to exit early because they had to return money to their LPs, right? So LPs definitely had a sense that it takes much longer than needed. The 10 plus 2 year cycles also sometimes are not enough, because first 5 years of the fund you're actually finding the opportunities to invest, and then you're thinking about exit outcomes. So a lot of the times, in fact, what's happening today in the market is a lot of funds are doing secondaries extensively to be able to get that liquidity and return money to LPs. So I think LPs, given that there have been a few cycles where they've invested across different funds, I think the learning is there that it will take 12 to 15 years or even more in terms of building a solid business. So people are thinking more long term. It's not about in 2 years can I 80x my money, which we saw in the bull run during the liquidity time, where we were seeing markups happening every 6 months, right? And the markups were also quite substantial. So people thought that this was a quick way to make money, but now that the funds have started sharing their reports in terms of how much money did they actually return to LPs, I think it's become fundamentally clear that it takes long term in terms of private market investing to work for you and in your favor. So LPs are getting cognizant of that.
That's a very interesting thought process, because most people who kind of reach out to family offices or talk to them, they present a value proposition saying this is what will happen in 2 to 3 years.
Yeah.
Whereas the fundamental ethos of a family office, the way I hear from you, is about truly understanding what it takes to build a long-term business.
Yeah.
So patience is not necessarily lacking. This is something that they live, breathe, operate firsthand, knowing that it takes 5, 10, 15, 20 years to build a business. So I think that's super helpful, because a lot of people who come in to the private market, they look at these stories in the Economic Times or Mint saying that I made 10x return in a 2-year period, which more often than not is like a sole exception versus being a norm. So glad to hear that. So when you guys are looking at kind of building out the assets, have you at all looked at the world of the funds, or it is only the individual investments that you have been doing?
So absolutely, we've looked at funds. We are also LPs in different funds, where we continue to invest wherever whichever domains we don't actively cover via the family office, and we don't have conflicts in the portfolio in terms of sector focus. I think those are the funds we typically like to work with. But like to your point of taking the longer term approach, to give you an example, my father started working in his teens when he lost his father, and he's well into his 50s and he's still actively working. So it's taken him almost 4 decades to build what he's built, right? So I think that learning in at least family businesses, you grow up seeing that. So you don't expect short-term money-making schemes, because they come across as Ponzi schemes, right? Because ultimately, when you're seeing how much effort it takes and how beautifully compounding works in these businesses, because growing up, we didn't think that we had capital to deploy or had enough liquidity to be able to invest externally. But now, when into the fourth decade of them running the business is where, we started exploring opportunities to invest elsewhere, which is where, I think family businesses generally have an understanding that, it will take 20, 30 years even. 10, 15 years is too compressed the timeline, and you put immense pressure on the companies to grow and scale, right? And I think that's what we saw in the last few years where, so many startups had governance related issues where there was so much investor pressure to keep growing at a pace which wasn't sustainable, and that's what backfired for a lot of these companies. Interestingly, we've seen that that condensed timeline is not healthy.
Doesn't
always.
Really help.
And unless you have true product market fit where you really need that capital to be able to grow and scale very aggressively, which rarely happens. It happens in very outlier and exceptional cases. You still need to take the sustainable long-term approach in terms of business building, focus on the fundamentals and unit economics and things like that.
No, that's so right. The whole power of compounding, Oyster is fundamentally built upon the whole power of compounding. In fact, like we were discussing before this session, that if you look from Oyster's standpoint, a lot of funds that family office typically invest, by and large, they are usually the more of the emerging fund managers, because what happens in the fund journey is as you move to your second fund, third fund, you deliver stronger credentials, your IRAs are becoming stronger and stronger, you have a proven track record. The focus tends to shift towards institutional side of the investors, right? Which is where we come in, because in some sense we take we co-invest along with the family offices, giving them access to the funds which have typically not been available to those family offices. So I personally feel that the power of compounding would significantly kind of play in over here as well.
Yeah, absolutely. I really believe in the power of compounding because, when it comes to institutionalized plays, you're absolutely right that, people, a lot of family offices, especially the large ones, do want a proven track record, right? Like people who are already on their second or third funds, they do not want to back first-time fund managers. But what's interesting is the smaller family offices with, say, maybe 50 to 500 million in terms of deployment, they are very open to the idea of working with first-time fund managers, especially focused on the earlier rounds like seed and mid-sized companies, where they understand that if you get in early and you back an emerging fund manager, because there are globally reports also now which talks about which talk about different emerging fund managers delivering a higher IRR because their fund sizes tend to be smaller versus larger funds which sometimes do not return spectacular returns in terms of sometimes it looks at 2 to 3x of the capital return. So there are different ranges, but one needs to take a portfolio approach when they're investing. So you can definitely have later stage investing combined with seed stage investing, and you need to be diversified across asset classes. Exposing yourself to just one stage and going very deep in it is also inherently risky.
And are you guys looking at any specific themes like the deep tech segment, the consumption story of India, the healthcare, the supply chain, and so on? I mean, do you guys look at some of those thematic side as well?
Yeah, so fintech, SaaS, and consumer have been the themes. I think consumption as a theme is increasingly standing out to us. We didn't do any consumer brands till about last year, and we've done 3 deals this year in consumer brands. I think what's very interesting to see is the adoption that quick commerce is bringing on board. You are seeing almost 30 to 40% of revenues coming from quick commerce for these consumer brands, and they're able to see exponential growth happen very quickly. Whereas, before, prior to this, consumption as a theme, while there was a lot of deal activity, a lot of them weren't able to scale because the market wasn't ready for it also in terms of market depth and, consumers willing to pay. But after the pandemic, I think there's significant behavioral shift which has happened, which is really fueling the consumption theme at large. So we are very confident on investing in that.
Great. So glad to hear that. So, but before we, wrap up the session for the day, any 2 or 3 things that you're seeing on the horizon that you feel family offices are truly excited about?
I think definitely having a front row seat to India's future being built, that is very exciting. Working closely with founders who are coming up with the vision of changing India and bringing India to the forefront, because the world's attention is on India, right? Everyone's talking about this is India's decade. So how do you participate in that, and how do you enable change at large? How do you empower people as they're building the country? I think that's very exciting. And taking our network of operators and helping the companies strategically, I think that is another thing that we get excited about, because just investing is not the part of the game, right? Portfolio management, being able to manage exits as well, that is also something that you need to look at as a family office. So continuing to look at those themes as well, I think is very important. But that must have come up a lot in your conversations with family offices. How do you think one should manage the portfolio once they've invested in companies?
No, I think you're right, and I think the interesting piece is, the family office in India is still a little bit of that enigmatic segment that most people don't know about.
Yeah.
I think a lot of people have perceptions, but a lot of these are very tightly held kind of structures where you really don't get a peek inside.
Yeah.
You don't know how the decision making is happening. Sometimes you also think that in the family office there are too many decision makers. So who is the actual decision maker? Where does the penny fall finally, right? But I think what we have learned is that there are 2 or 3 core themes. I mean, it starts from making sure that there is an adequate returns, and then there's a track record of investment. We're talking about fund managers. There are at least about 40 odd fund managers in India who have done 3 funds, right?
Yeah.
They have a consistent track record. There is a whole focus that even though there is an element of patience, there is this whole thought around liquidity. So there are enough funds which have now, in our parlance, what we call the DPI, right? There are enough funds who have delivered real cash returns back to the investor. So I think that makes a world of a difference.
Yeah.
And finally, like you were talking about, the thematic aspects, I think a lot of family offices are now well progressive enough to be able to see where, what direction that the wind is taking, what are the oncoming segments. They have interest to kind of participate in something like a deep tech, which supposedly is higher risk but also higher returns. But they also have the core side of the whole consumption economy that you talked about. We're talking about being a massive consumption economy in the next 4 to 5 years. I mean,
Yeah.
already getting there. So those are the core themes that I think a lot of family offices that we interact with or who invest along with us into some of these funds that we see excited about. But great, lovely to have you with us today. Thank you so much. And for all our people who have joined us today, I hope you got a good insight into the minds of the family offices, and a lot of the things that keep floating around in the air may not necessarily be true. So we got the first-hand information from Shrishti, who manages her own family office, along with a bunch of others, over $100 million deployed into the segment.